Well, it's Wednesday, and we are discussing the latest economic headlines. So we're now joined by financial expert Chuck Zodda from the Armstrong Advisory Group. Chuck, as always, thanks so much for the time.
Yeah, great to chat with you today.
All right, so after a bumpy end of last week, stocks have bounced back a bit, but how much of that is now linked to expectations of a potential Federal Reserve rate cut next month?
Well, I think some of it could be that, but I think more often than not, what we see in markets is, when there is some downward volatility, it doesn't move all in one direction typically. You might see these relief rallies where markets try to regain previous levels. And so I think until we continue to get more information that changes things in either direction, you might see just a little bit of choppiness here from day to day. So, what could change things to the positive side of things? Hey, if there's, an improvement in the tariff situation, or if we start seeing, some improved labor force numbers, or if retail sales next week end up being strong, great. Those could be things that help to make this market go higher. The counter to this is, hey, if we start getting more data points pointing towards a slowing economy, that starts to drag us down a little bit. And even rate cuts aren't necessarily enough to, kind of stem the bleeding there. It could be something where ultimately you have to remember that usually the reason for rate cuts is because the economy is weak. And if that is the case, then you have to watch out for how stocks may behave once bad news starts being priced in as bad news, not just good news that could potentially lead to rate cuts.
Now, President Trump's tariff deadline is tomorrow, but here's the question that I had for you. Is Wall Street still putting stock into these deadlines, or are investors just expecting the worst and making trades based on that? And what, if anything, might lead to a poor investor sentiment?
Well, I think the big thing with these tariffs is there still is uncertainty as to what's going to end up in place and what might simply be a negotiating ploy. And so I think this is an ongoing question that we look at. And so ultimately, I think what markets are doing at this point is trying not to get too excited about any of the particular announcements, but instead wait to see how they're implemented and what kind of follow through there is. So I think it's very much a wait and see approach right now. And that's going to kind of be the standard operating procedure until proven otherwise, given what we've seen over the last 6 months or so, as far as how tariff rates have evolved from initial announcement to final implementation.
Apple announced a $100 billion manufacturing commitment to the United States at the White House. Obviously, Apple is such a massive company. How much of an effect do you see this having on jobs and the economy?
I think we're going to need to see the details in order to understand exactly, how this potentially impacts the economy here. Clearly, the president wants to see more U.S. manufacturing, and so this obviously could point in that direction. But we don't know on what time frame this is talking about. We don't know exactly what products or what lines this is going to be focused on, and so I think we'll need to get more information before we can definitively say, hey, it's going to impact the economy in ways X, Y, and Z. The other thing to remember, and this is not specific to any particular administration, we've seen a lot of these announcements over the years that ultimately might end up not bearing fruit. There were a couple during the Biden administration of new chip facilities that ultimately ended up being scaled back. They still moved forward, but not to the extent that we thought they were going to be. Likewise, during the first Trump administration, Foxconn, who is a Taiwanese manufacturer, had a big plant they were going to try to build in Wisconsin that ultimately ended up being reduced in size pretty dramatically as well. So I think you take all of this with a grain of salt and understand that it can change. None of this is legally binding when it comes to how companies may change their plans in the future. And so I think this is something that we just need to watch and see how it develops here.
If someone has $10,000 to invest into a brokerage account right now, what would your advice be to them?
I think the big things are number one, you need to figure out what do you actually want this money to do? Is this money that you're trying to grow for the long term over 20, 30, 40 years? Is it money that you're trying to keep safer and a little bit more stable? What do you want this to be used for? Number two, do you actually understand then what you are going to be investing in? A lot of times, people get, hyped up on, the latest hot particular stock or, sector of stocks. But do you actually understand what you're investing in? Maybe it's not even stocks. Maybe you're looking at bonds or maybe something else entirely. Make sure you have a good understanding of what the risks are with those investments and how those risks may end up affecting your portfolio. And the final piece is it's kind of related to that. Understand your own risk tolerance. Ultimately, there's no best investment strategy. You have to find the one that works for your particular risk tolerance, because if you abandon what you are doing partway through when things get challenging, usually you end up with subpar results. So you might say, "Oh, this new stock looks, really exciting." But if it pulls back 30%, are you going to be able to stomach that and stay the course? Or does that scare you off and now you end up taking a big loss right before the thing rallies further? So I think understanding what you're investing in, why you're investing, and your own risk tolerance, those are the three big things that you need to focus on when you're trying to make that decision of what do I put this money into?
See, I'm a lucky man because whenever I need advice, I got you on speed down, Chuck. So appreciate the time as always, Chuck Zodda from the Armstrong Advisory Group. Thank you so much for joining us once again.
All right. Have a great rest of the day.